Hi everyone, welcome to the Patient Wallet channel. We did it. The portfolio return is a negative 1.2% or a negative of £233. Last week has been brutal for the whole market and my portfolio. We have Amazon down 14%, Google down 4.5%, S&P Global down 17%, Adobe down 8.7%. It seems there is no bottom for the stock. Fair Isaac is down 7.6%, and lastly Netflix is down 2%. Overall, the portfolio was down 8.4% on the last week, and as a result, we are sitting today in a negative territory. As promised, I wanted to show the good and the bad of investing and picking individual stocks, so here we are, and in this episode, what I'm going to talk about is explain why I bought some additional S&P Global, look at what is happening in the market, which I think one image explains the whole thing. And lastly, look at the facts around the hyperscalers and focus on their cloud businesses to understand which of the three companies between Alphabet, Amazon, and Microsoft stands to benefit the most going forward. If you like this type of video, please make sure you like the video and subscribe to the channel to help us reach as many people as possible. And let's jump into the video, starting with why I bought 2 additional shares in the S&P Global following the initial 10% decline of the stock. And the reason is pretty simple. When I look at the overall businesses of S&P Global, it's split into 5 businesses here. We have the market intelligence in red, the ratings in blue, commodity insights in orange, the purple is the mobility business, and then lastly on green we have the indices business. When I looked into why S&P Global was down 10% on the day, the narrative was that AI would kill or disrupt their business. Looking at their businesses, to me it's pretty clear that only one business is most at risk to be disrupted by AI. Starting with ratings, this is basically the language that the market has to rate debt. This is essentially a way to understand what the riskiness of debt is, and as a result the market is able to price certain debt, which means this is very difficult for AI to disrupt. It's not necessarily the process that is difficult, but it's difficult to replace a language that the market is used to, or in other words, it's very difficult to exchange a verification process that S&P Global provides to the market. Next up we have indices, the green business down here, which is essentially the benchmark business. If you invest in the S&P 500 ETF, which is benchmarked against the S&P 500 or follows the S&P 500, S&P makes money. I am not even close to understand how AI will disrupt this, and this business I think remains as it is and continues to grow going forward. Next up, mobility, this slither of purple here, basically a business that management will spin off S&P Global, so I don't care about the mobility here. Then we have commodity insights, which also includes benchmarks, and in my opinion, very difficult to replace as this segment acts as a benchmark and provides dynamic and real data around commodities. And the one business that is basically at the highest risk to be disrupted by AI is the market intelligence. The profitability of this business for the overall business is 15%, and the company is already down 17%. In my opinion, this is an unjustifiable sell down for the stock, and as a result, I picked up some more stocks in the company. Moving on, let's look at the S&P 500 map to understand what is happening in the market. And I think this image perfectly describes what is currently happening in the market, and simply put, it's a rotation play. You'll see that the AI and CapEx heavy names are in the red, and the rest of the market is in the green. You have Microsoft, Amazon, and Google, which we'll see soon, reported astonishing CapEx guidance being in the red. The AI trade from the chip side or manufacturing side is also in the red, along with some earnings reported in here, and broadly the remaining of the stock market is in the green. That's pretty much what I think is happening, which is basically a rotation away from AI and CapEx heavy businesses to the remaining of the market. Now let's look at the Alphabet and Amazon cloud data that I wanted to look at as they reported earnings late last week. Starting with Alphabet, I thought the report and earnings call was great. Google Cloud grew its revenue by a staggering 48% year on year, and total revenue for the cloud business sat at $17.7 billion for the quarter ending December 2025. And if we look at the revenue backlog for the business, it grew at a rate of 161% and now sits at $242.8 billion US dollars, which is a staggering number for Google and proves that Google Cloud has a long runway to grow going forward. For AWS and Amazon, AWS revenue reaccelerated, growing by 23.8% year on year, and revenues at $35.6 billion US dollars for the quarter ending December 2025. And we can also see that the backlog numbers also reaccelerated, growing by 38% year on year and sits at $244 billion US dollars. And you'll see that technically Google is very close to Amazon when it comes to cloud backlog. One detail I wanted to highlight, because some people are a bit confused and looking at the growth rates, it's a bit misleading given the difference in the size of the two businesses. It's important to understand what is the absolute gain in revenue terms for all the hyperscalers, including Google and Amazon here. Unfortunately, Microsoft doesn't report Azure separately every single quarter, so I'll use this example here, and it's something that the CEO of Amazon was essentially firing shots during the earnings call late last week. Even though we see that Google Cloud business grew by 48% and Amazon AWS only grew by 24%, the absolute gain in revenue between the two businesses tells a different story. When you switch to the last 12-month trailing revenue for AWS and Google Cloud, and then you compare the absolute revenue gain for the two businesses, you can see that the difference between December 25 and December 24 for Amazon is roughly $21 billion US dollars. And for Alphabet, the equivalent comparison, so looking at the last 12 months revenue for Google Cloud between December 25 and December 2024, you can see that the revenue gain is $15.5 billion US dollars. So the quarterly growth rates are much higher, but when you zoom out a little bit and look at the last 12 months trailing revenue and absolute basis for these businesses, you can see that AWS gained more in absolute terms. And the reason is the scale is completely different for these two businesses. So that's important to keep in mind. And let's bring some data from Azure as well to understand how these three hyperscalers compare to each other and where we might see them going forward. What I've done here is I've added the last 12-month revenue for each of the businesses here. The only caveat is Azure is not reported on a quarterly basis. We knew that 6 months ago, Azure had a revenue of more than 75 billion. And during the earnings call, they mentioned that they grew by roughly 40%. So what I've done, I've taken 75% and grew that by 20% to come to 90 billion US dollars. And then I took basically the last 12-month growth rate of AWS and Google Cloud and the 34% increase that Azure grew 6 months ago year on year. Simply multiplying their last 12-month revenue with the latest growth rates we have available, we can see that next year, that's how revenue might look like. And the absolute gain, when you compare that in dollar terms, essentially, you can see that AWS will have 25 billion more in revenue, Google Cloud 21 billion, and lastly, Azure, if these assumptions are correct, will grow by 31 billion US dollars. In other words, the biggest gain will be Azure, but Amazon remains the leader with a good margin ahead of number 2 and 3, which is Microsoft and Google. Lastly, let's look at the CapEx numbers that they reported and guided during their earnings report. We have here a chart that shows the capital expenditure for the last 12-month period for each of these companies. In red is Amazon, in blue is Microsoft, and in orange is Google. And you will see that over time, Amazon always spend more in CapEx than the other two competitors here. And when it comes to CapEx guidance, these are the numbers here. Amazon guided for 200 billion US dollars in CapEx for next year, Google 180 billion, and Microsoft 150 billion US dollars. Again, keep in mind, they don't provide a guidance of CapEx, but I took the last quarter CapEx and annualized that by multiplying it by 4, which leads to 150 billion US dollars. Fun fact, if you combine the CapEx for only these three companies, it totals to 530 billion US dollars. And when you compare that number with the GDP of whole countries, the CapEx spend that these companies are expected to go through is higher than the country number 32 when it comes to GDP. So the 31st largest country ranked based on GDP is Thailand, with a GDP of 558 billion US dollars. Next up is Norway with 517 billion US dollars. The CapEx spend for these three companies sits just after the 31st country, which is crazy. There are only 31 countries that produce more GDP than the CapEx spend of these companies for 2026. Nuts. We'll see how long this lasts and how long these companies can keep spending this kind of money to expand their growth and capture the AI demand. And lastly, I wanted to touch on the idea of how are these companies going to be financing their CapEx spend. So what I've done here is I've included the cash flow from operations in this column, and then the right column is basically the cash flow from operations, less dividends and less buybacks. Amazon pays no dividend or buybacks, so their cash flow from operations is the same in both columns. But for Google, you can see that cash flow from operations is 165. When you adjust for dividends and buybacks, that's $109 billion. For Microsoft is 161 billion, and when you adjust for the same is 113 billion US dollars. Google and Microsoft can technically say we are stopping the dividend or the share buybacks because their stock price will tank, which means they are locked in this commitment to pay out dividends and share buybacks. In my opinion, Amazon is in a better position simply because I think the money held within the company and invested in expanding their infrastructure is more worthwhile for shareholders today, even though the short-term pain is the same for both companies. It might even feel better to get some share buybacks and dividends in the short term, but longer term, I think Amazon is better placed because growing their infrastructure means they can bring capacity online faster, and given they are all supply constrained, as soon as this capacity comes online, they're able to monetize that capacity straight away, which I think at the end of the day will lead to good investment returns in these investments. So this is how I think of these companies. If I had unlimited capital, I would want to own all of these companies because technically AI or not, digitalization needs cloud infrastructure, and these are the three hyperscalers which I think will benefit for many, many years to come. I'll leave it at that. That's it for this episode. Thank you for watching, and I'll see you in the next one.